China and Russia just shut the door on the US dollar. Completely. Not in theory. Not someday. Now, oil, minerals, microchips, they're trading in rubles and yuan. And while Washington demands China open its markets, American exporters are bleeding out, small businesses are collapsing, and Asian central banks are sitting on a $2.5 trillion bomb, ready to dump. Trump thinks tariffs are leverage. But what if they're a loaded gun pointed at our own economy? Stick around because the fallout just hit Wall Street and your job might be next. How do you negotiate entry into someone else's house while deadbolting your own door from the inside? That's the paradox unfolding in Trump's latest trade talks. While Washington pushes Beijing to open its markets wider to U.S. companies, it's enforcing a 145% tariff wall that's choking the flow of Chinese imports. The math isn't theoretical. Importers must now charge $18 just to break even on a $10 item, according to May 2025 pricing data. Scott Bessent insists it's about securing a great deal for America, but the White House is demanding concessions while offering fewer of its own, even as U.S. exports to China still top $140 billion and support over 500,000 jobs. This imbalance is deepening, not resolving. And here's where it gets stranger. If America truly believes access to Chinese consumers is critical, why does it keep making its goods more expensive, less competitive, and harder to sell overseas? That contradiction hasn't just weakened its leverage. It's put U.S. businesses on defense before the first hand is even played. At the ports of Los Angeles and Long Beach, container volumes from Asia are down nearly 40% compared to last year. But this collapse isn't mirrored in China, it's redirected. According to April 2025 trade data, Chinese exports to the U.S. cratered 20%, yet total global exports rose 8.1% in dollar terms. Beijing has simply rerouted goods to Southeast Asia and Europe, both of which saw double-digit import increases. That rerouting didn't happen by luck. It was built into supply chain shifts already underway since 2023. The U.S. hoped tariffs would freeze Chinese factories. Instead, China recalibrated, swapping one trade partner for 10 more. So the question becomes, did tariffs pressure Beijing or just reroute the trade lifeblood toward markets less hostile? And if China can rewire its shipping lanes this fast, what does that say about who's truly dependent on whom? China hasn't issued fiery press releases or headline-grabbing bans. Instead, it imposed a 125% tariff on U.S. goods and walked away. The results speak louder than rhetoric. Shipments of U.S. products into China have plummeted, with companies like Apple, McDonald's, and Starbucks suddenly facing a shrinking foothold in cities where they once dominated. S&P data shows American firms earned over $1.2 trillion in China last year, 4 times the size of the U.S. trade deficit. Yet, the consumer switch is already in motion. Luckin Coffee now rivals Starbucks in Tier 1 Chinese cities, and Huawei continues to claw back market share from iPhone sales. If this trend accelerates, American brands won't just lose revenue, they'll lose relevance. So here's the tension. Can U.S. exporters withstand this market freeze, or is Beijing quietly closing the window on their future? Pause, because this is the moment it all turns. The White House sees collapsing container shipments as victory, a supply squeeze designed to force China's hand. But what if that's not leverage, but evidence of self-inflicted harm? In May 2025, Bessent met with Chinese officials in Switzerland. Trump called it a very good meeting, yet no announcements followed. No frameworks, no memoranda. At the same time, small businesses across the U.S., from WS Game Co. in Massachusetts to florists in Kentucky, have confirmed delays, cancellations, and unsustainable costs. WS Game, for example, lost $16 million in retailer orders and has $500,000 worth of products stranded in China. If Washington sees this as strategy, it's ignoring the smoke coming from its own engine. Because when your supply chain is gasping and your exporters are collapsing, maybe it's not the other side that's blinking. In a joint declaration this spring, Russia and China confirmed what markets had already begun pricing in. Their bilateral trade is now almost entirely settled in yuan and rubles. That includes oil, gas, minerals, and high-value industrial goods. According to statements from both governments, the aim was to create a sustainable system protected against attacks from third countries, a clear reference to sanctions and currency dependency. As of April 2025, over 50% of China's total trade is conducted in non-dollar terms. And SWIFT data shows yuan usage in cross-border transactions jumped from 2% in 2021 to over 4.3% in Q1 2025. But the real shift isn't in payment systems. It's in confidence. A dollar is only as strong as the willingness to use it. And right now, Beijing and Moscow are building trade channels that can function without it. The next question is, who joins them next? A financial time bomb may already be ticking under the US dollar, and the detonator is $2.5 trillion deep. According to Eurozone Stephen Jen, exporters in China, Taiwan, Vietnam, and Malaysia have quietly accumulated more than $2.5 trillion in dollar reserves since 2020. That reserve pool is now unstable. Following the U.S.-Taiwan trade talks, the Taiwan dollar spiked 8% in 48 hours, its largest move since 2007, and triggered synchronized currency strength across Asia. The ICE dollar index dropped 9% in 2025, and traders are bracing for what Jen calls a non-linear sell-off, where multiple countries dump dollars simultaneously to avoid being the last one holding a devaluing asset. But this isn't just currency speculation, it's a structural signal. With the Fed expected to cut rates by 75 basis points this year, and dollar assets already overvalued, Asian central banks now face a simple question: unload quietly or get crushed in the rush. The answer may rewrite America's global financial role, and that fallout hasn't even started. In Massachusetts, WS Gameco had $500,000 worth of merchandise stranded in Chinese ports, then lost $16 million in U.S. retail contracts in one quarter. In Oklahoma, 4K9 saw tariffs destroy its ability to import dog seat covers, despite growing demand. Lisa McDonald's tea house in Michigan, which imports premium leaves from China, says she's weeks away from pricing herself out of her own market. All three cases come from different industries, but share the same plea: help isn't coming. These aren't giant corporations. They're lean, resilient American brands being outpaced by a policy machine that won't return their calls. Trump's tariff policy is hitting smaller firms the hardest. Unlike multinationals with diversified supply chains, local businesses can't reroute decades-old sourcing strategies overnight. And while Besant insists the U.S. is still the premier destination for global capital, mom-and-pop shops are going under before that capital ever reaches them. So, what happens when the economy Washington is trying to protect can't survive its protection? Even if a deal is struck, the tariff doesn't go away. According to White House trade officials and direct comments from Besant at the Milken Institute, Trump is committed to a permanent 10% baseline tariff on all imports, even from allies. That framework doesn't just punish adversaries, it embeds cost into the entire U.S. supply chain. The Kiel Institute estimates that this strategy will cause U.S. exports to fall by 17%, with American producers absorbing the difference or losing market share. In contrast, China and its trading partners expect only a 5% decline in exports, easily offset by their lower cost base and willingness to operate on thinner margins. This means the country pushing hardest for trade realignment is also the one making its goods least competitive. And with tariffs now priced into everything from manufacturing components to consumer goods, the very industries meant to be protected are being priced out of global relevance. But what if this isn't about economics anymore? What if it's about signaling strength regardless of cost? If China walks, Wall Street could follow, and so could the dollar. If Chinese consumers decide to stop buying American goods, the impact will be immediate and brutal. In 2024 alone, the U.S. exported over $140 billion in goods and $46 billion in services to China, supporting nearly 900,000 direct U.S. jobs. California alone exports $15 billion annually, with Texas pushing over $21 billion. But the larger risk isn't just to exports, it's to the markets. According to S&P Global, U.S. companies generate 7% of their annual revenue from China. If those earnings vanish, so do forecasts, dividends, and investor confidence. And when Wall Street bleeds, the dollar limps. International demand for U.S. equities and treasuries depends on perceived growth and stability. Strip away Chinese consumers, and you don't just crash a few earnings reports, you tilt the entire asset ecosystem. Investors don't wait for official statements, they run at the first sign of contagion. So the real question becomes, can the U.S. keep its currency dominant while making its biggest trading partner walk? This isn't just a tariff war. It's a coordinated unraveling of the post-1990s trade consensus. And the data shows we're past the tipping point. China has rerouted its exports, decoupled its currency flows, and tripled down on yuan-based settlements. Russia has cut out the dollar entirely. Asia's exporters are preparing for a dollar exodus. And while the U.S. insists its markets are still open, its tariff regime says otherwise. Small businesses are collapsing. Wall Street is exposed. And the dollar is wobbling under the weight of policies designed to look tough, but which may prove strategically fragile. So ask yourself, if the dollar no longer anchors global trade, does America still anchor global power? And what happens to every American business, loan, and investment riding on the assumption that the dollar will always win? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.